Welcome to Conversations in Commercial Banking. Today, we'll be hearing from Keith Rofrano, Head of Middle Market Solutions Group for CIBC, and Wendy Holder, Head of the Dallas Commercial Market here at CIBC, as they offer perspectives on how to help commercial clients navigate in this environment. This will include aspects of the macroeconomy, current client behaviors, and best practices. And now over to our hosts.
Well, hello, Wendy. It's great to be with you today to talk all things market, and hopefully shed some light on what our clients are facing and help them maneuver through what are always challenging times, but in this environment, particularly challenging times. And so, boy, I guess the way I would describe it, the economy, let's start with the economy, is really stable facts, and then cloudy when we think about future risks ahead. There is so much going on. There's a lot to be encouraged about. For example, GDP is quite strong. Wages are growing. They're growing faster than inflation, which indicates real wages going up. That's a positive sign. The market pricing, as we look forward, is pricing somewhere between 2.3 and 3% inflation. So inflation expectations are fairly well anchored. That's over the next 3 years. Of course, stock market highs. It's hard to not be excited about that. And at the same time, we've got, the Fed's preferred dual mandate looks pretty strong, pretty stable. So CPI coming in most recently at 2.7% gives us a good indication that inflation, again, is relatively in check. It's come off quite a bit from the highs years ago of near 9% and is somewhat stable. So a little bit higher than the Fed would like, but still seemingly very manageable as I think about and listen to our clients across the board. Also have to talk about the jobs market. So yes, it's off its rip-roaring days, but it's also pretty stable, and it's not nearly as much of a concern as it was maybe 6 months ago. And so we're still adding to the non-farm payroll number. The headline unemployment is roughly 4.4%. Again, all very positive signs. And so all this sort of backdrop has led the Fed, what looked like 2026 was going to lead to 2 to 3 rate cuts, is now looking like 1 to 2. And so what that done is it's sort of steepened up the yield curve and has posed, some new outlooks, some new ways that clients behave around that. But we have to remind ourselves that it's normal to have an upward sloping curve. It's generally healthier for the economy in the long run. I say all that with some notes of caution. There's clearly a lot of concerns, mostly in the neighborhood of geopolitics. And while we can, go on and on about things like Venezuela and Greenland, renewed tariff threats, we feel like we've gotten behind and digested the initial threats of tariffs, but yet here they are again. And so we can we can scenario play, and I think that's all healthy discussion, and we should pay attention to certainly what's going on. But when we think about our clients, I think what we really want to focus on are how can we control the controllables? How can we get ourselves in position to understand the things that can hurt us and to have a plan? What is always hard to see, and when we see this sometimes in our client behavior, is intuition is great, but intuition in and of itself is by itself is not the healthiest thing to have. So, intuition becomes good judgment when you have a plan. And so the plan could be as simple as starting to think about, starting to do the math, starting to conversate with industry alike, with your bankers, with other partners that you have, your suppliers, your clients, and talk about the things that you'd like to avoid. And so I guess that's my backdrop, big picture on the macro economy. And Wendy, I'd love to hear what kind of behaviors and opinions you're seeing and how the clients think about the macroeconomic backdrop in this environment.
Sure. Always great to visit with you, Keith. Even though the environment remains somewhat unpredictable, I'm finding that most of our clients are still cautiously optimistic. From a commercial banking perspective, we're seeing clients become more selective and disciplined, especially around capital investments and expansion. Many are pausing on new lines of business or foreign acquisitions. But at the same time, we're seeing strong inbound activity into Texas, particularly from our Canadian clients. which really highlights the growth opportunities that do still exist, even in these uncertain markets. Clients, as you mentioned, are increasingly looking to us for insight beyond lending, especially around liquidity, cash management, risk management, and understanding exactly where their cash is coming from and where it's going.
Yeah, excellent. You mentioned spending, Wendy. I'm curious because, when we look at the data, again, the facts tell us that CapEx is actually at, all-time record highs, but it's really driven by property, plant, and equipment, the usual, but also technology and software. And certainly the AI boom is a big chunk of that spending that continues to push it high. I'm curious, do you see things around the manufacturing sector or other things that would lead us to be maybe a little bit less optimistic about that CapEx number that we see in the data?
I do still see clients investing in things such as new facilities. So CapEx is still a big part of the picture for CNI clients. However, M&A activity remains very slow. So we're hoping to see some pickup, but as of now, it is remaining very slow.
Yeah, that actually tracks very well with what we're seeing in the data. But I agree, we're not seeing nearly as many conversations or risk conversations around foreign M&A. So a lot of that, you know, um, sort of trend that occurred in the initial wave of tariff threats where we were thinking about reshoring or nearshoring or friendshoring, that still is out there in the market and still very much ingrained into client behavior. So I think there's some good domestic numbers to talk about. There is absolute caution, and I would say at least in the international CapEx investment side.
From a market risk perspective, what are some of the things that you are seeing?
Yeah, so it's always a really good question, Wendy. From market risk perspective, I like to think of it sort of in two ways. And the way we open the conversation, there's the facts and the things that we know, and then there's a whole sea, an infinite sea of things that we don't know. And so what I always think a healthy exercise to do is to look at some of the tried and true behaviors that are extremely useful, and also point out some of the ones that are less useful and maybe need to be given a rethink from our clients. And so I guess I'll start with the ones that are more useful. So, um, you know, clients that are generally dollar exposed, and I say that knowing full well that the U.S. dollar is the currency of choice. By far, it is the preferred international settlement of choice. And so what that leads to often is complacency in the FX markets where we have clients who buy or sell in US dollars and they're happy to negotiate that price as such. The problem with that, and the thing that needs to be, given a closer look is when you get in environments like we have today, where the dollar is generally weaker with the forecast expected for a little bit further weakening, you think about what that means for the importer, right? First and foremost, we still are a net importing nation. And so when that happens and the dollar starts to weaken overseas, what that does is it puts margin pressure on their foreign suppliers. And so what we'll often see in response to that is we'll see foreign suppliers that will reprice that dollar invoice to our client and just call it an FX wash. Now, the academic part of me would say you should always settle in the foreign currency. And in so doing, you're the one controlling the risk. You have 100% visibility to the risk, and ups and downs, even if you don't manage the risk, is 100% visible and transparent to you, the firm, as opposed to looking at the risk through somebody else's lens and being the receiver of whatever price adjustment or fear factor they may have. I also realize that academics is not the world that we live in. We live in reality where account payables and systems, et cetera, and oftentimes a foreign supplier may very much prefer to receive US dollars because they have a dollar payable themselves. So that is all to say that, it's not necessary that you flip everything over into foreign currency. I would say I would invite you to take a look at just the math behind it, the risk behind it, so that you're prepared if and when the dollar continues to weaken, what that might do for suppliers. So the client behavior that we see, I would say, is still very much US dollar centric. However, the client behavior that I'd like to see more of is an examination of how does that invite more risk into their P&L and the running of their business. On the interest rate side, which is the other big asset class that we spend our days talking about, thinking about, working with clients on, as I mentioned in the opener, the curve has steepened up. And so what once was a discount or what we call a positive carry to hedging against your 1 month SOFR exposure to lock in a 3 or a 5-year interest rate has gone away. And so for some clients, obviously they look at that and say, well, I wish I woulda, right? And again, I kind of would point out that I wish I woulda isn't exactly a great plan. So what we can do, and the behavior that I think is most healthy now, is to think about what is the risk tolerance of my interest expense? How much can I tolerate? Not can I predict the market? Predicting the market is a very, very difficult task. We just talked about, the facts that we knew in the economy. We talked about some of the numbers that the Fed is dealing with, but I also mentioned there's a slew of geopolitics, and one of them is also the changeover in the Fed. So we have a ton of uncertainty ahead of us. I always like to think about, what is the best behavior? The best behavior is protect what you know to be a potential negative outcome or prevent a negative outcome for your business. That is an exercise that is done well with your partner. Particularly, we're very interested in helping our clients think through that math or think through the scenarios that would put them at risk and have a plan against that. So as I said, the difference between intuition and good judgment is having a plan. So Wendy, if I had to wrap a bow around all this and I had one word to choose, the word to avoid would be complacency. Avoid complacency. But Wendy, the reality is you as a banker and a market lead, you have the ability and really the privilege to look across clients and see things, across all aspects of their business. And I'm just curious, from an overall banking perspective, how would you paint some of the most important things that clients should be thinking of today?
I would say preserve borrowing capacity, even if you don't need it today. Just having the ability to make acquisitions or for unexpected disruptions is key. Maintain the flexibility to pivot if needed. Using debt as a strategic tool so you can move quickly if supply chains shift, assets reprice, or competitors might hit a rough patch. And finally, I think one of the most important things is to lean into your banking relationships. Use the bank as a sounding board and a thought partner, not just when you need credit, but to get market perspective and think through what's next for the business. If clients can do those few things, protect liquidity, keep options open, and lean into their relationships, they're going to be in a great position no matter how the economy unfolds. We've talked about a lot of topics today, some big, some more specific. And as Keith mentioned, the most important thing is the dialogue with you. We stand ready, willing, and able to continue further discussion. Please don't hesitate to reach out. Thank you for your time.
CIBC is a member FDIC and equal housing lender. Loans are subject to credit approval. Guests of Conversations in Commercial Banking are not paid for their participation. To the extent that information contained herein is derived from third-party sources, although we believe the sources to be reliable, we cannot guarantee their accuracy. The CIBC logo is a registered trademark of CIBC used under license. Investment products offered are not FDIC insured, may lose value, and are not bank guaranteed.